What is your message to him at the moment, and what is his message at this moment by going to Shanghai?
Well, he's trying to stretch his hands out. Shanghai was probably one of the most damaged major cities by the draconian zero COVID lockdowns. We didn't face the same type of shutdown in Beijing, and Shanghai was kind of seen as a poster child for one that had kind of fallen afoul of, let's say, central government regulations around managing zero COVID, and therefore was subjected to the most strict lockdowns. And the PTSD that left, both for its residents as well as global investors, will not soon be forgotten.
The PTSD that many an investor has is then the regulatory crackdown that Xi Jinping had on the tech investment area more broadly. How do you think that investors are seeing a post-COVID and post-regulatory enforcement world for China?
Well, the regulators are doing everything they can to try to assuage those fears that there will be an ongoing interference in the markets. And when I had the chance to whisper a few thoughts to President Xi last week, I said, please get your hand out of the markets and get a better PR team, because you need people that can explain why you're doing what you're doing and explain well ahead of the time that it takes place, so that people don't fear that there's these unexpected twists and turns and unpredictability that would cause them to flee the market. And it's that volatility with the strong returns on the U.S. side that would cause a lot of global investors to say, why is China worth the risk if I could go plop my money in the U.S. at these kind of returns?
Shanghai and some of its high-tech parks are the site of AI development. They're the site of chip design firms and actually, to some extent, gaming. 24 hours ago, we posed this question about the regulatory crackdown on gaming and where we stand now. Just have a listen to this.
I think that most of the regulatory changes are behind us now, and that people have some stronger footing to move forward. There's still huge amounts of money to be made in the Chinese games market.
Ben, that was Lisa Cosmas Hansen, partner at Nico Partners, president of Nico Partners. She was talking in the context of gaming, but broadly across the technology sector. Is she now carrying out a supportive policy, or is still having some heavy regulatory overhang on those sectors, many of which based in Shanghai?
I think that regulatory intervention is over. And again, it squares with the type of tone that he took during his speeches at APEC, particularly the one that we were attending on Wednesday night, where he was, really olive branch out. The state of the Chinese economy is dire. The last thing they need is further shocks and further interventions in the technology giants that are seen as bellwethers. And so I don't expect further interventions. That doesn't mean that the world will believe that. And we've got to show that through proof. And again, that's why they really got to come out clearly and state that. Just having photo ops at SenseTime or Pinduoduo or SMIC won't do it. They've got to make that clear to investors and then show it over the coming year before a lot of that trust can be rebuilt.
From a pure technology and competence perspective, are you seeing evidence that China is standing on its own 2 feet?
Certainly. I mean, the pace at which China's been able to develop its own chips beats any kind of global precedent. China's numbers in terms of publications in magazines, in Nature magazines, or other kind of scientific sources is off the charts. Numbers of patents being filed. The ability of Huawei to now obviously issue its own operating system with Harmony. We are truly now witnessing what I think a lot of us, poo-pooed maybe early on, which was kind of the reality of a true decoupling. And we are finding ourselves in a balkanized world where there will be a set of Chinese hardware, operating systems, app stores, and customer bases, and then those balkanized from those of Western producers.
How balkanized will the investor base eventually be, Ben? This is what you deal in day to day, accessing pools of liquidity from the West to be going into China. And at this time, we're looking at Shein, which, of course, would say it's not a Chinese company, but it once was. And ultimately, a lot of its stock comes from there. But it's now based in Singapore. But they're going to be tapping an American investor once again. How do you see the liquidity being brought to bear for Chinese investments?
It's been tough this year. I think a lot of that is, again, down to performance. So as you know, we have for the first negative FDI since 1998 in China. We had 75% of the capital that flowed into China this year, and the public markets flow out about 25 billion. But I think, again, a lot of that is returns driven. The capital that is not returns influenced is being scared away for, let's say, non-fundamental reasons. And that, I think, pertains more to geopolitics. And those investors are looking for opportunities to invest in China still. They believe it fundamentally is a growth opportunity, but they want to do so in a way that helps them navigate these geopolitical uncertainties. So they want to know that the companies they're investing in aren't going to aid and abet the PLA. They're not going to necessarily compromise American values. And so I think companies that can prove that ilk are going to continue to see and attract capital if they can return the type of profile that's required to kind of compete with those U.S. Opportunity costs. And so I think that capital will return, but that takes the stability. And those companies that are not on those, that are falling afoul of that, the likes of SenseTime or 4Paradigm, or those that are kind of have connectivity to CCP entities or the PLA, I think they will attract a lot less capital because of the geopolitical concerns going forward.
Ben, we were just showing the performance of the NASDAQ Golden Dragon Index year to date. I think it's trailing the NASDAQ 100 and S&P 500. Either way, what do you see as being the 2024 story for China tech?
We have to be ever bullish, and I really am. I mean, I'm talking my own personal book in terms of what I put my money into. The numbers are irrationally discounted. That Alibaba is trading at or near its IPO valuation, yet with 10 times increase in revenue, makes no logical sense. And again, if we can sustain the growth, and I think China will hit its 5% target this year. The IMF even raised that target to above 5%. Heading into the tail end of this year. I think that China has the tools to deploy. The fundamentals are sound in the economy. The real estate picture is overblown in terms of the impact it will have on the true economic drivers in the economy. It is not a Lehman moment. And therefore, we are actually piling into Chinese equities and taking them out of the American ones that we think are probably fully priced at this point and just can't manage to sustain this type of upside that we've experienced throughout this year. So I'm a China bull heading into next year, even if it's a more modest bull than I would have been in that kind of growth spurt from 2017 to 2021.